All right, let's be honest. We all get into investing for one simple reason, right? To make money. But there's a crucial second part to that mission that so many people just forget about, and that is keeping the money you actually make. So today, we're going to dive deep into the world of brokerage fees. Think of them as these silent portfolio killers that can just eat away at your returns.
Let's just start with a number that should really grab your attention: 28%. Over a 40-year investing career, a seemingly tiny 1% annual fee can devour nearly a third of your potential retirement savings. No, that's not a small leak. That is a massive hole in your financial boat. You got to remember, every single dollar you pay in fees is a dollar that isn't compounding for you. And as we're about to see, those dollars add up in a big, big way.
So here's our battle plan for today. First up, we're going to identify the enemy, these hidden fees. Then we'll talk about choosing your weapons. That means picking the right broker and account. After that, we'll get into the nitty-gritty of the most common fee out there, trading commissions. And we'll uncover some of the stealthier fees you need to watch out for. And finally, we'll put it all together into a solid strategy you can use to protect your profits.
Okay, Section 1, Investing's Hidden Hurdle. Look, it's super easy to get laser-focused on picking the right stocks or the next big thing. But the truth is, the fees you're paying are like a constant headwind, always slowing down your portfolio's growth. Understanding this and minimizing that drag is seriously one of the most powerful things you can do for your long-term returns. That brings us to Section 2, Choosing Your Broker. Your battle against fees starts right here, okay? Before you even think about placing a single trade, picking the right brokerage and the right type of account, that's your first line of defense. It really sets the foundation for everything else.
So what even is a brokerage account? Well, the easiest way to think about it is like a special kind of bank account. You put money in, but instead of using it to, buy groceries, you use it to buy, sell, and hold investments, like stocks. And when you sell a stock, the money goes right back into this account. It's basically the command center for all your investing activity.
Okay, so right away, you're going to face a choice. Do you go with a discount broker or a full-service broker? Discount brokers are really for the do-it-yourself investor. They've got lower fees precisely because they expect you to make your own decisions. Full-service brokers, on the other hand, well, they charge more, but that's because you're paying for hands-on help, financial advice, even a dedicated advisor. There's no single best choice here. It's all about what you need. You want to pay less and fly the plane yourself, or pay more to have a co-pilot? Next up, you've got the platform itself. And you'll generally see two types. Client-based platforms are these dedicated programs you actually download and install in your computer. They're often packed with more powerful, advanced tools, which is great for really active traders. Then you've got web-based platforms, which is what most of us are used to. You just log in through your browser. Super convenient, nothing to install. Again, it really just comes down to personal preference and how much firepower you actually need. And what about getting started? A common question I hear is, how much money do I actually need? Well, a margin account, that's an account that lets you borrow money from the broker to invest, usually requires about $2,000 to start. But honestly, the barrier to entry can be way lower. A lot of brokers will let you open a standard cash account with as little as $500, so getting in the game is often more accessible than you might think. All right, let's move on to the fee you are going to see the most often, the trading commission. This is basically what your broker charges you for doing their main job, placing your buy and sell orders. And understanding how these are structured is absolutely critical if you want to manage your costs.
So, here's the deal. Every single time you hit that buy or sell button, your broker is the middleman, right? They're connecting you to the market. The commission is just their service charge for making that happen. And yeah, it might seem small on any single trade, but remember that 28% we talked about? For an active investor, these are exactly the kinds of fees that add up and create that massive drag over time.
Now, brokers usually charge these commissions in two main ways. On the left, you've got your flat rate commissions. This is super straightforward. You pay one fixed price, let's say $9.99, and it doesn't matter if you're buying 10 shares or 1,000. Then on the right, you've got per share commissions. Here, you're paying a tiny amount, maybe a penny, for every single share you trade, but there's usually a minimum fee. And this table right here shows exactly why you need to know the difference. Let's say you're a low-volume trader, buying just 50 shares. That flat rate of $9.99 is way more expensive than a $1 per share fee. But flip the script. If you're trading in high volume, say 10,000 shares, that same $9.99 flat rate is an amazing deal compared to the $100 you'd pay with the per share model. The right choice completely 100% depends on your trading style.
Now, for those of you trading options, things get a little more complicated. The commission structure here is often a hybrid model. What does that mean? It means you'll pay a base flat rate,
maybe something like $9.95, just to place the trade. And then you'll pay an additional fee for every single contract you trade, say $1.50 per contract. You've got to account for both parts of this fee.
Let's just walk through a quick example to make this crystal clear. Imagine you're trading 5 options contracts. First, you start with your base commission, the $9.95. Next, you figure out your contract fees. So $1.50 times 5 contracts equals $7.50. Finally, you add them together. Your total cost for that one trade isn't just under $10, it's $17.45. You see how quickly that can add up if you're not paying close attention.
Okay, commissions, those are the obvious ones. But now let's talk about the fees that are kind of hiding in the fine print. These are the ones that can really jump out and surprise you if you aren't actively looking for them. They might be less frequent, but believe me, they can be just as damaging.
So here's a quick rundown of some fees lurking in the shadows. If you trade on margin, you're paying interest on that loan. If you trade options, there's a pretty hefty fee, often $20 to $25 if your option gets exercised or signed. And, super relevant to our topic today, you have transfer fees. When you want to withdraw your profits, some brokers will charge you just to move the money to your bank. Even worse, if you want to move your whole account somewhere else, you can get hit with an account transfer fee that's sometimes over $75. That's a huge one to look out for. And finally, there's this indirect cost called payment for order flow, which is a little tricky.
And that leads us to a really important question in modern investing. I mean, you see commission-free trading advertised everywhere, right? But how are these brokerages making any money if they aren't charging you to trade? Are those trades really free?
Well, here's the answer. This quote nails it. A huge reason for these free trades is something called payment for order flow. Your broker literally sells your trade orders to big trading firms. Those firms then execute your order, and they make a profit off the tiny difference between the buy and sell price. We're talking a fraction of a penny on your trade. So it's an indirect cost. It doesn't show up on your statement, but it could mean you're not getting the absolute best price on your trades.
So we've gone over the obvious fees and the not-so-obvious ones. Now, let's put it all together and build an actionable strategy. This is your personal toolkit for defending your portfolio from getting eaten away by all these costs.
Okay, here's your checklist. Number 1, match the commission model to your trading style. Are you high volume or low volume? Number 2, before you deposit a single cent, read the full fee schedule so you know all about costs like withdrawal fees ahead of time. Number 3, and this is a big one, ask if you can negotiate your rates. 4, always be mindful of that options assignment fee. 5, compare the cost of paying a commission to close a trade versus just letting it expire and maybe getting hit with that assignment fee. And finally, use a paper trading account first. Get comfortable with the platform without risking any real money.
I really want to double-click on this point because it is so important. A lot of investors, especially new ones, they just assume the fees listed are set in stone. They're not. Especially as your account gets bigger or your trading volume goes up, you have leverage. Don't be afraid to actually call your broker and ask for a better rate. I mean, the worst they can say is no, right? And you might be really surprised at what you can get.
And let's bring it all back home. Why does any of this matter so much? Because saving on fees has the exact same effect as earning a higher return. Every single dollar you don't pay to your broker is a dollar that stays invested, a dollar that can grow and compound, a dollar that is working for your future, not theirs.
So, we end right where we began. That tiny little percentage point can have a huge impact on your life, potentially costing you years of income in retirement. But the good news is you now have the knowledge, you have the strategy to fight back. So the final question is, what's the very first step you're going to take to start cutting your costs?